Okay, so picture this. You finally start doing the, responsible thing. You're funneling money into your savings account. Maybe $100 here, $200 there. And honestly, you feel incredibly disciplined. You feel financially mature. But then you look at your account balance and you hear literally everyone else buzzing about compound growth and investing. And you kind of have to wonder, wait, am I actually doing this wrong? Well, no, you're not wrong, but there is a catch. Stashing cash is an absolutely fantastic start, but saving alone, it rarely builds real wealth. So welcome to this explainer. Today, we're going to break down the exact step-by-step path to help you confidently transition from a saver into an investor. And we're going to do it without you feeling like you're gambling away your financial security. Okay, let's dive into this. Here is our roadmap for today. We're going to start by unpacking the savings illusion. Then we'll look at the sheer power of compounding and talk about overcoming investing anxiety. After that, we'll map out your actual step-by-step path, and finally, we'll wrap up with mastering market crashes. So, part 1, the savings illusion. Good behavior, poor results. Now, it is perfectly normal to feel a massive sense of pride when you start stacking cash. Having $10,000 saved up feels incredibly responsible, right? But let's take a hard look at the reality of stagnant cash. Right now, a typical savings account might yield, say, 0.5%. What does that actually mean? Well, it means after an entire year of keeping your hard-earned 10 grand locked away, you've earned a whopping 50 bucks. Yeah, that is barely enough to buy a couple of decent pizzas for all your trouble.
And honestly, this brings us to a somewhat controversial but absolutely vital truth. Savings protect your money, but investments grow your money. These are two completely, totally different financial jobs. Saving is absolutely crucial, for sure. But you have to remember, it's really just stage 1, not the final goal.
All right, moving right along to section 2, the power of compounding, the math of wealth. If saving is just that first step, we really need to look at the math that separates the cash hoarders from the real wealth builders. And this brilliantly illustrates exactly what I mean. Let's compare that same $10,000 over a 20-year period. Left in a savings account at a 1% rate, you end up with around $12,200. But if you invest it, keeping in mind the S&P 500's historical average is right around 10% a year, you end up with over $67,000. It is literally the exact same starting money, but a wildly different reality.
Now, that massive gap we just saw, that isn't magic, it's compounding. Compounding is essentially the process where your investment earnings go out and generate their own earnings over time. You know, a lot of people think the biggest wealth gap out there is between people who save and people who spend. But actually, scratch that. It's really between people who just save and people who invest. Compounding is literally the engine of long-term wealth.
Which brings us to section 3, overcoming investing anxiety, the mindset shift. So, you might be wondering, if the math is that undeniably obvious, why doesn't everyone just invest? Well, the reason people get stuck isn't the math at all, it's the psychology. Let's be real. Saving feels safe. It's highly visible, it's right there in your app, and it doesn't just suddenly drop 5% on a random Tuesday. Investing, on the other hand, it feels incredibly risky. The market swings up, it swings down, and that emotional whiplash absolutely terrifies people into clinging to their cash because they're so afraid of losing it.
To overcome this, we really need a mindset shift. I want you to think of saving money kind of like storing seeds in a glass jar. You are protecting them perfectly, yes, but absolutely nothing grows in a jar. Investing is like taking those exact same seeds and actually planting them in the soil. Sure, it looks messy at first, and no, you don't see results immediately, but over time, they grow into something far, far bigger than the original seeds. True growth means you have to leave the sterile safety of that jar.
Let's get into the how-to, section 4, the step-by-step path, the action plan. Let's move to and see how this builds, because if you were sitting there right now thinking, listen, I just don't want to lose my savings, that is entirely fair. And that is exactly why this transition shouldn't happen all at once. Here is a 5-step progression designed to basically strip away Wall Street's complexity, totally remove the fear, and let you ease into the market safely. Step 1. Before you invest a single dime, you need to build a cash fortress. We're talking 3 to 6 months of living expenses saved in plain old cash. Now, this isn't dry powder waiting around for you to buy stocks, it's an investment shield. The #1 reason people panic sell their investments at a loss is because of a sudden, real-life liquidity crisis, like a medical emergency or a job loss. Having this safety net keeps your investments untouched and protects your portfolio from the curveballs of your own life. Moving to step 2, and this is a massive psychological trick. Separate saving from investing mentally.
I want you to imagine two totally separate buckets. Your safety money bucket is your emergency fund. It literally does not move. Your growth money bucket is your investments. And guess what? It is allowed to fluctuate because its entire job is to just grow over the long haul. Once you mentally separate these two, I promise you, your anxiety is going to drop dramatically.
Now, steps 3 and 4 are all about execution. You want to start small, and you want to keep it ruthlessly simple. You don't need thousands of dollars to begin. Literally start with 50 or 100 bucks. And please, for the love of your sanity, ignore the complicated day trading or the wild crypto speculation. Keep it boring, but highly effective, with low-cost index funds. This is the exact simple strategy that legendary investor Warren Buffett relentlessly recommends for pretty much everyone.
Step 5 is the glue holding it all together. Stay disciplined. Now, what's really interesting about this slide is the sheer power of consistency. Imagine investing just $300 a month. Assuming an average 8% market return, after 25 years, you're sitting on roughly $285,000. But the real magic is in the breakdown. You only personally contributed $90,000 of that. The rest, almost $195,000, is pure compounding growth. It's essentially free money, triggered entirely by your own discipline.
Finally, let's tackle the big one. Section 5, Mastering Market Crashes, the Long Game.
You know, discipline sounds incredibly easy when the charts are all green and pointing up. But what if you start investing and the market completely crashes? It's the ultimate beginner fear, right? But listen, those dramatic, scary headlines and red downward arrows, they are absolutely inevitable. Market downturns are perfectly 100% normal occurrences, historically speaking.
But here is the massive mindset shift that truly separates the amateurs from the wealthy. Long-term investors actually benefit from downturns. Think about it. Because you are investing monthly, a market drop simply means your cash is suddenly buying way more shares at heavily discounted prices. It is basically an economy-wide clearance sale. Experienced investors, they don't panic. They stay completely calm because they are thinking in decades, not days. They know the strongest returns often come when the market recovers.
So the crucial point is this. Saving and investing are an incredibly powerful combination, but they serve two very distinct purposes. Saving money gives you the stability to actually sleep well at night, but investing gives you the freedom to build a wealthy future. And the earlier you combine both of these forces, the more powerful your financial life is going to become.
Which leaves us with one final pretty important question to ask yourself today. Take a real look at your own accounts. Are you currently settling for that glass jar stability of the saving stage? Or are you actually ready to take this step-by-step path, plant your seeds in the soil, and start growing your true financial freedom? Let that sink in for a minute and start making your plan.